In this episode of the MSA Rental Market Update, we are looking at the Raleigh rental market for multifamily properties, specifically conventional multifamily properties. So as you can see, we have the Raleigh metro statistical area drawn out by CoStar, and notice that Durham is not included in this MSA. So if you're expecting Durham, you're not going to get it in this video. I do not have Durham on my list. So if you want Durham or Greensboro on my list, neither one of them are there yet. Neither is Fayetteville. We just did Charlotte yesterday. So you can see kind of the research triangle as we get through this area where a lot of people are investing, including Charlotte. We also have Wilmington down here. Fayetteville is a military town. And then we have Norfolk, Virginia up here. And you can see we have Columbia, South Carolina down here. All right, so this gives you an idea where it's located. But let's take a look at our filters like we always do and see that we are excluding all corporate, all military, all senior, and all vacation. And we are only including market and market affordable, so that we are only looking at conventional apartments, as I mentioned earlier. If we look at location, we can see that we are in market, metro statistical area, Raleigh, North Carolina. Interesting that Durham is not part of the Raleigh marketplace. I thought it would have been, but it is not. Okay, so let's go take a look at the analytics and see what it looks like for all asset classes first, combined, A, B, and C, and then we'll look at each one individually. So here is our supply side snapshot for the Raleigh MSA. We can see there are 1,212 properties totaling 117,317 units. There is still 14,633 units under construction. Only 1,117 units absorbed in the last 12 months, where the previous 12 months, 4,327 units absorbed, or the meaning of that is with the positive number, there were 4,327 more renters than there were vacancies. That's what that means. And it's just a result. We can see that where vacancy a year ago was 5.9%, it is now 8.9%. Pretty big jump, 3%. Yet we are still showing a year-over-year rent growth of 2.1%. We'll see what it looks like quarter over quarter. As usual, we are not looking at the capital markets. We are only looking at the space markets. If we scroll down and look at our long-term occupancy average, we can see that this market likes to be right around 93%, and it's currently right around 91%. So 2% below that long-term occupancy average. And as usual, since we have under construction, we have slowing absorption and we have increasing vacancy. That tells us that we are slightly below that long-term occupancy average in between the oversupply and recession phase of the market cycle. But let's go look at our data and see if our data can confirm that. So here is the data analytics for all asset classes combined. We are not looking at asking rents. We do not care what the owners are asking for rent. We only care what they are collecting. First quarter 2022, we collected 1513 up to 1584, and the break occurred as it normally does. It went down to 1557 and then 1516. So we've seen this break between the second and third quarter in a lot of markets, and Charlotte was no different. So let's take a look at our construction, our deliveries, and our absorption and see how they handled. So if we look at deliveries, we had 1,612 deliver in the first quarter, only 360 absorbed. That is not good. So you can see that downtick big time of 1% in occupancy. Okay, then we had another 796 units deliver and only 661 absorbed. Little bit better absorption, but not enough to catch up. Went down another 0.1% in occupancy. And then things start to go really bad. We had 1386 deliver, new vacant to the market, and another 63 went vacant on top of that, lowering the occupancy to 92.4. Then another 796 delivered vacant, and another 262 go vacant in addition to that. So These delivered vacant or delivered new. These additional vacancies are people that have moved out of existing units. When you combine those together, it tells a pretty sad story. So we can see that our data is definitely confirming that we are heading down into that recession phase for the Raleigh MSA. But let's see what each individual asset class tells us and see if there is a specific asset class dragging it down, or if they're all doing it equally, or will it be like we've seen all across the Southeast where the Class C markets tend to stay up even though we were negative absorption in all 4 quarters. We'll see if that holds true for Raleigh. I have not seen the data, so let's go look at it together. Let's go take a look at the Class A's. So here is our Class A analytic data. There are 101 properties totaling 27,449 units. We are looking at effective rent, and we can see we started at $17.14 in the first quarter, went up to $17.88, down to $17.49, down to $17.04. So we were actually lower in the fourth quarter than we were in the first quarter to start the year of 2022. Not a good sign, but once again, that inflection point between the second and third quarter, we saw those rents start to decrease. Let's see what deliveries and absorption tell us. So not a lot of deliveries in the Class A space. Says that the rest of those deliveries were in the Class B space, but we could see that we had 727 deliver in the first quarter vacant, and another 36 went vacant in addition to that. It did try to catch up slightly with 128 going occupied with no deliveries, but then we had another 441 deliver vacant to the market and another 100 that went vacant in addition to that. So we have some very, very slight absorption with 0 deliveries, and we have some negative absorption with some bigger deliveries. So we're looking at about 1,168 units total delivered and almost a complete wash. So 0 absorption. We got 136 and 135. So -1 absorption to 1,168 units going vacant. So not a good sign for the Bs. And as we can see, the Bs started at 94.9 going into 2022 and are now all the way down to 90.9. And that is an indication of that. So the A's demand and supply is reacting appropriately to the fundamentals. Let's see what story the Bs are telling us. So here is the Class B rent analytic data. There are 294 properties totaling 60,781 units. Looking at effective rent, we started at $15.27, went up to $16.05, and as with the other 2 data sets we've looked at, it started to go down to $15.77 and then down to $15.35. So below second quarter rents, but slightly above first quarter rents ending the fourth quarter. So if we go and look at our deliveries and absorption, we can definitely see we delivered more Bs than we delivered As. We had 885 deliver and only about 50%, slightly more than 50% absorbed. Not good. But then we had a good absorption of 796 and 702 absorbed. I like to see 80 plus. Then things start to go badly. 945 delivered, only 147 absorb, another 532 deliver, and another 107 go vacant. So that definitely explains our downfall from 94.1 to 91.2% in occupancy, causing our rents to go down. So as with the A's, the Class B space is definitely slowing. The renters are definitely roommating up, or what we call doubling in the marketplace. Could be moving in with parents or doing things like that. That is causing demand issues, because we know for a fact that people are moving from the Northeast and they are stopping in North Carolina. They're not making it all the way to Florida. So we know we have population growth, but because of affordability, we are seeing roommates roommate up, and that causes our demand to diminish. So Class A's and B's don't look very good. Let's see if the Class C's tell us the same story the rest of the Southeast does, or if it reacts a little bit more appropriately in the Raleigh market. So let's go take a look at our C's. So here is our Class C rent analytic data. There are 687 properties totaling 27,787 units in the Raleigh metro statistical area. We're looking at effective rent, and in the first quarter, we were at $1,231, went up to $1,278, and look at this. Folks, I think this is one of the first markets that we have seen. Actually, I think this is the second or third market where we actually had a break point between the second and third quarter for Class C. That doesn't bode very well for Raleigh. That's interesting, but it probably is acting appropriately to absorption. We should not have any deliveries in the Class C space, but let's see what absorption tells us. And sure enough, as I suspected, negative absorption in all four quarters. We can actually go back, much like Charlotte, where we go all the way back to second quarter of 2021, which was the last time we saw positive absorption in this market. What does this say? This says that the renters can no longer afford these rents, and so they are doubling or they are roommating up, okay? And we can see that in the occupancy. You can see that occupancy is at 93.1. Remember, that long-term occupancy is right on about that 93% mark, and so it looks like this market is a little more sensitive to occupancy than what we saw in Charlotte. But there is, without a doubt, an indication that this market is in the recession phase. I would even, because of these Class C rents declining the way they are, negative absorption in all three asset classes in the fourth quarter, I am going to definitely plot this one dot below the long-term occupancy average, putting it a little further into recession than Charlotte. Keep in mind, we still have what was it? I think 12,000 plus units left to absorb, and we are negative absorption already. So not a good sign. We can definitely expect those rents to come further down. I'm not sure how far they're going to need to come down in this market, even though 12,000 is a whole lot to absorb. The market may be able to sustain a little bit sooner than like what I'm thinking in Dallas. There's going to be about a 20% rent drop because there's over 38,000 units still left to absorb in Dallas. I'm not sure we'll get that far down. I think we'll definitely go down about 10%, maybe somewhere between 10 and 20. I don't think it'll reach 20%, but you never know, it might. These renters obviously are being hurt by inflation. They're being hurt by these high rents, and so they're roommating up so that they can afford it. So that concludes the Raleigh Metro Statistical Area Rental Market Update. Stay tuned tomorrow for what I believe is going to be one of the worst markets we've seen in the country, but we don't know until we look at it. So tomorrow, look for Phoenix, Arizona. I'll see you guys tomorrow.